women-headed entrepreneurship will become the new driver of job growth in the future. Local governments wanting to promote pro-entrepreneurial growth should focus less on firm casing, attracting large mature firms from somewhere else, and focus more on encouraging entrepreneurship in their community. Q. Examine the causes of rising inequality and unemployment in the manufacturing sector post-economic reforms. 250 words BPW Introduction. The economic reforms of 1991 were held as a watershed moment in the growth trajectory of India. However, after 25 years of economic reforms, the scenario has changed, leading to rising inequality and unemployment in each and every sector. The manufacturing is also not an exception to it. The relationship between market imperfections and wage growth in the Indian manufacturing sector underscores rising inequality and unemployment in the sector. Causes for rising inequality and unemployment: market concentration. The impact of market competition on industry wage structure is dialectical. Firms with higher market power pay higher wages compared to competitors. However, if the market power translated into a monopoly position, then the company may resort to cost cutting, leading to relatively decreasing wage growth. www.insightsindia.com 15 www.insightsays.com. The liberalism brought outside competition, stiff competition from neighboring countries such as Bangladesh in case of apparel sector, China in case of steel, etc., which forces indigenous manufacturers to cut down their employees, resulting in inequality and unemployment. The capital-intensive industry grew at the expense of labor. The intensive industry, monopoly by bigger industry in terms of machinery, technologies, etc., does not allow small companies to expand their business. C. Skill set of the labor is poor. L. Lack of skills among the workers as compared to their counterparts in other countries. D. Lack of entrepreneurship potential. Lack of encouragement to entrepreneurship spirit among the young entrepreneurs. The exports affected in global volatile market. The export prospects has decreased since the global financial crisis. Also, this is the period when India thought of encouraging manufacturing industry through Make in India, yet all low purchasing power domestically. The domestic market is huge, but is not viable for the manufacturing industry due to lower power purchasing capacity. Other general problems of land acquisition, ease of doing business, credit facilities, etc. Way forward a neutralize negative impact of liberalization. Countervailing and anti-dumping duties on those goods which are detrimental to local manufacturing industries. B. Encourage MSMEs to absorb labor. C. Skill upgradation. Upgrading skills of workers as per the demand of contemporary manufacturing sector. D. Encourage entrepreneurship. Instilling entrepreneurship spirit among the youth. Robust labor reforms. Flexible ease of doing business procedures. Credit facilities. One-stop clearances, etc. D. Enhance exports. More cesses. The easies needs to be created along with tax holidays, incentives, etc. There is a need to diversify export locations in developing economies. Connectivity like the Northeast Sea and through Caladan Port and other multilateral projects. Our industrial and trade policy must be aligned. F. Integrate Bartlett and Salgardla for more robust and efficient manufacturing. www.insightsindia.com 16 www.insightsays.com. Q. Financial resolution and deposit insurance bill tries to bring global standards to resolution of financial firms, but there is a strong case for keeping deposits out of the bill's purview. Analyze. 250 words The Indian Express. The Hindu Introduction. Need for Resolution Corporation. RBI has used the powers available under the Banking Regulation Act to deal with bank failures and weaknesses in case of private sector banks. The Deposit Insurance and Credit Guarantee Corporation, the ICGC schemes, have been used only to a limited extent in case of commercial banks, but they have been used extensively to protect depositors of weak and failing urban cooperative banks. The RBI has no powers of resolution in case of public sector banks. Under the existing legislation, there are no legal provisions for the RBI to resort to options such as receivership, bad bank, good bank, bridge bank, etc. The proposed bill gives such options to the Resolution Authority. FRBI adheres to global standards. 1. Global norm. It is important to have the Resolution Authority with sufficient legal powers to explore the variety of options for resolution, without recourse to the sovereign's budget, under any circumstance. In the case of large and complex financial firms, regulators insist on living wills. In addition to capital reserves and provisions that create a buffer against losses, regulators can also require banks to issue a special category of debt instruments that have a loss-bearing capacity or bail-in provisions. In many countries where such laws have been already enacted, there is a bail-in provision as well. These include the UK, Canada, Australia, the EU, but, in some cases, deposits have been excluded from the purview of bail-in. 2. Financial Stability Board recommendation during the global financial crisis. Many governments had to use taxpayers' money to bail out banks deemed too big to fail. Thus, under the auspices of the G20 Financial Stability Forum, it was recommended that each jurisdiction should have clear legal provisions for dealing with the resolution of financial firms. Such firms cannot be dealt with under the normal bankruptcy laws. They operate with public funds, as deposits or insurance premium or contribution to pension funds or money invested by public in units of mutual funds, and in debt instruments issued by non-banking financial companies. There needs to be clarity on how the assets of the financial firms can be used to settle different types of debt liabilities. Why keep deposits out of the bail-in? In a country like India, where there has not been any banking crisis and where the public needs to have a safe place where they can invest their savings rather than keeping it under the mattress or buying gold, depositors need to have safety of funds. FSDC Group has suggested that bail-in clause should exclude bank deposits. The group recommends that the bail-in framework should cover the capital instruments, additional Tier 1 and Tier 2, as well as other unsecured creditors' deposit liabilities, interbank liabilities, and all short-term debt, which if subjected to bail-in can induce financial instability, would be excluded from bail-in.